In this video lecture, we will be covering the topic of bond valuation. These are our learning objectives. We will understand the concept of bonds and related terms, types of bonds, the concept of coupon rate, YTM and YTC, the concept of valuation of bonds. This is your reference book. Please go through chapter number 7 of Brigham and Houston Fundamentals of Financial Management. So what is a bond? A definition of the bond is that it is a long-term debt instrument in which a borrower, also called an issuer, agrees to make payments of principal and interest on specific dates to the holder of the bond. So basically, a bond is a type of loan, as you can see from the word debt over here. So it is a type of loan and it is a long-term debt instrument. So it's going to be for more than 1 year in which a borrower or an issuer. So usually your borrower or issuer in this case is your government or your corporation. So whenever they require money, for example, if a corporation wants to open up a new factory and for that they want to issue bonds in order to raise the money. The corporation requires money, they're going to issue bonds in the market and the bonds will be purchased by investors in the market. So I can purchase a bond, even you can purchase a bond. We will be the holders of the bond because we have purchased the bond. So holder of the bond simply means the investor who wants to invest their money. Now, another important terminology over here is agrees to make payments of principal and interest. Because it is a loan like any other loan, the principal amount, which is the loan amount, has to be returned, plus interest has to be paid on it on specific dates. So for example, if the corporation has taken a loan of 10 million at a 10% rate, so the corporation will have to return this 10 million, which is the principal amount, to the holders of the bond, plus they will have to pay the cost of borrowing, which is 10%. So they will also have to pay this, and these payments are made on specific dates. So moving ahead, now before actually I move ahead, you need to be sure that who issues bonds. So bonds can be issued by government, which are called your treasury bonds in the US. And it is reasonable to assume that the US government will make good on its promised payments. So treasuries have no default risk. So usually the risk, if the bond is issued by the government, it is considered to be default free. There are less chances that the government will not will default on those payments. Then you have bonds that are issued by corporations, but corporations do have default risks. So depending on who is issuing the bond, you need to consider different types of risk. We will discuss this also later. Let me just erase all of this. Now, some important terminologies that are specific to bonds is face value. Face value is the face amount of the bond which is paid at maturity. Face value is also called par value and it is the stated amount of the bond. So, for example, if the par value of a bond is 1,000, when the bond matures, you will get this 1,000 back. The par value generally represents the amount of money the firm borrows and promises to repay on the maturity date. So this is basically your loan amount that the firm will return once a bond matures. Matures means once a bond finishes. Then the second definition is the coupon interest rate. So like any other loan, there is going to be interest payment over here, which is shown, which will be calculated using your interest rate. And for bonds, that interest rate has a name. It is called coupon interest rate. It is the stated interest rate paid by the issuer. Multiply the par value to get the dollar amount of interest, which means that, for example, For example, if the bond has a par value, a face value of, let's say, 1000. So this is the par value. This is the amount that will be returned once the bond ends. This is the loan amount. So if you purchase one certificate, you will be giving a loan of 1000 to the corporation. And let's say this has a coupon rate of 10%. So if you multiply them, you will get to know the coupon payment amount, which is going to be 100. So this is your coupon payment. This is the interest payment that the corporation will give to the investor. Then another definition is the bond price, which is the present value of bond after discounting all future cash flows. We will go into this in detail. How do we calculate the bond's price? Then the issue date is when the bonds are issued. So this is the date when the bond is going to start. And the maturity date is years until the bond must be repaid. This is the duration after which the bond will end. For example, if a bond has a maturity of 5 years, that means after 5 years, the bond is going to finish off. The loan will be returned and all interest payments will be made.